Listen to me very carefully, because what I'm about to say is going to make some people uncomfortable. I don't care. If your banker gets offended, that's their problem. I care about one thing only: whether you're going to have any money left 10 or 20 years from now. And if you think this conversation doesn't apply to you because your banker smiles, wears a nice suit, and knows your kids' names, congratulations, you're exactly the person this applies to. Here's the first truth nobody tells you. Banks don't hate you. They don't need you to lose. They just don't need you to win. That's a very important distinction. As long as you feel safe, as long as you feel taken care of, as long as you feel like you made a smart, responsible decision, the system is working perfectly. For them. The real danger isn't that you lose money overnight. That would at least get your attention. No, the real damage is slow, quiet, and polite. It's fees you don't notice. Returns that look okay. Documents so thick they could stop a bullet written in a language nobody speaks at home. And by the time you realize something is wrong, 10, 15, 20 years have passed. That's when people look at me and say, "Kevin, how did this happen?" I'll tell you how it happens. You trusted the wrong incentives. You assumed the person across the desk was paid to help you. They're not. They're paid to sell. And they're very good at it. If selling financial products were an Olympic sport, bankers would have more gold medals than swimmers. This isn't about intelligence. I've seen doctors, engineers, business owners, very smart people get absolutely destroyed by safe bank products. Why? Because nobody warned them. So consider this your warning. This conversation is about your money, your future, and whether you stay in control or slowly hand it over while someone thanks you for your business. Let me explain something calmly this time, because I want you to understand the system, not get angry at the individual sitting across the desk from you. This isn't about bad people. This is about a machine that works exactly the way it was designed to work. I've spent decades inside this world. I've been on the sales side, the investment side, the boardroom side. I've seen the spreadsheets you never see, and I've sat in the meetings you're never invited to. Every banker you meet has numbers hanging over their head. Quotas, monthly targets, product goals, bonuses tied directly to what they sell, not to how well you do 10 years from now. No one walks into a bank on Monday morning and gets told, "Go help clients build long-term wealth." They get told, "Push this product, move this amount of money, hit this target by the end of the quarter." Miss it too many times, and you're not having coffee with clients anymore, you're cleaning out your desk. So when you sit down for what you think is a friendly professional financial review, understand what's really happening. It's a sales meeting, a very polished one. They ask about your goals. They nod thoughtfully. They say things like tailored, customized, and my personal favorite, exclusive. That doesn't mean it's good. It means it pays well. Here's the uncomfortable truth. A banker cannot put your interests first, even if they want to. The system won't allow it. If they recommend the simplest, lowest-cost solution, the kind that actually helps you long-term, they make almost nothing. And nobody gets promoted for making almost nothing. So the advice quietly shifts toward complexity, toward products that sound impressive, toward strategies that require a lot of paperwork and a lot of patience. Your patience. Their commission clears much faster. I'm not saying your banker wakes up in the morning plotting to hurt you. Most of them are decent people trying to keep their jobs. But the moment you understand that advice is often just sales wearing a nicer suit, everything starts to make sense. The smiles, the urgency, the fear-based language, the act now before rates change, routine. That's not strategy. That's retail. And once you see it, you can't unsee it. Let me say this clearly because this is where people get defensive and they shouldn't. If you've ever bought one of these products, it doesn't mean you're stupid. It means you're human. And banks understand human behavior better than most psychologists. That's not an insult, that's a business model. People don't buy financial products because the math is beautiful. Nobody gets excited about spreadsheets. People buy because they want to feel safe. They want to feel reassured. They want to sleep at night believing they made the responsible choice. And most of all, they want to feel smart. They want to walk out of that branch thinking I handled my money like an adult today. Banks don't sell returns, they sell relief. Think about how these conversations actually feel. You're not rushed. You're not pressured, at least not obviously. The room is calm. The language is soothing. Words like protection, guarantee stability, and peace of mind get repeated like a lullaby. And you know what? It works. It works incredibly well. Because fear of loss is far more powerful than the desire for gain. Losing money hurts. Missing out feels abstract. Banks exploit that gap. Here's the trick. They frame everything so that questioning the product feels reckless. If you hesitate, it's positioned as you being emotional, impatient, or unsophisticated. If you ask too many questions, the tone subtly shifts like you're being difficult. Nobody says it out loud, but the message is clear. Smart people trust the process. Smart people don't overthink this. Smart people sign. And that's the moment the decision gets made, not with logic, but with identity. You're not buying an annuity or a fund or a policy. You're buying the feeling that you did the right thing. You're buying approval. You're buying insulation from regret. The return doesn't have to be great. It just has to feel justified. I've watched incredibly successful people fall into this trap. Business owners who negotiate million-dollar deals suddenly go quiet when a banker starts talking about guaranteed income. Why? Because money tied to your future hits a different part of the brain. It's not about winning anymore. It's about not messing up. So, if any of this sounds familiar, don't beat yourself up. That's exactly the reaction the system is designed to produce. Once you understand that banks sell emotions wrapped in numbers, you stop blaming yourself and you start asking better questions. That's where real control begins. Now, let's get specific, because this is where the fog lifts and the mechanics become painfully clear. I'm going to move fast, not to overwhelm you, but because these products all follow the same playbook. Different packaging, same outcome. First, equity-indexed annuities. This is one of the most beautifully marketed products ever created. The pitch is irresistible. You get exposure to the stock market, but you're protected from losses. Your principal is guaranteed. You hear phrases like upside without downside, sleep at night money, perfect for retirement. Who wouldn't want that? It sounds like someone finally beat the system. Here's the reality. Your upside is capped. Usually 4, 5, maybe 6%. The market can soar 20%, 30%, doesn't matter. You're stuck at the cap. On top of that, you don't get dividends, which historically make up a huge portion of long-term market returns. Then come the fees. Layered, quiet, persistent. 2 to 3% a year isn't unusual. And the real trap, your money is locked up for years. Need it early, you pay massive penalties. I've run the numbers. Over a decade, a simple index fund can outperform these annuities by hundreds of thousands of dollars. The annuity didn't protect you, it protected the commission. Next, structured notes. These are sold as sophisticated solutions for smart, high-net-worth investors, custom engineering tailored risk, elegant design. It all sounds very impressive usually because it's explained very quickly. What they don't emphasize is that a structured note is just a loan to the bank. Your so-called guarantee is only as strong as the bank issuing it. Remember 2008. Ask Lehman Brothers note holders how that worked out. Even when the bank survives, your money is locked up for 5 to 7 years with no real liquidity. The fees are baked in invisible, which makes them even more dangerous. I've seen $500,000 notes where the bank pockets tens of thousands on day one. Best case scenario, you match the market. Worst case, you underperform while taking on bank credit risk. Congratulations, you assumed more risk for less reward. That's not investing. That's volunteering. Finally, proprietary mutual funds sold by banks. This one looks innocent. We recommend our own funds, they say, managed by our expert team. Sounds reasonable, right? Here's what's really happening. These funds exist to keep your money in-house. The fees are high, often 10 to 20 times what low-cost index funds charge. Performance is usually mediocre. Why? Because banks aren't great asset managers, they're great fee collectors, and the conflict of interest is enormous. The advisor recommending the fund benefits when you buy it. Over 20 years, that extra 1 or 2% in fees can quietly drain hundreds of thousands of dollars from your portfolio. You don't see the money leave. You just wonder why you're always a little behind. Different products. Same ending. Complexity, restrictions, and fees that work beautifully for the bank and quietly against you. Now we move into the products that don't just drain accounts. These drain options dignity and, in many cases, family futures. This is where the conversation stops being abstract and starts getting very personal. Let's talk about reverse mortgages. The pitch is almost poetic. You're told you can unlock the value of your home without selling it. No monthly payments. Stay where you are. Live with dignity. For retirees who are house-rich and cash-poor, it sounds like compassion wrapped in paperwork. And that's exactly why it works. What's rarely emphasized is that this isn't free money. It's a loan that quietly grows while you sleep. Interest compounds, fees stack, insurance premiums get layered in, and the clock is always ticking. I've seen this play out more times than I can count. A couple in their late 60s takes out a reverse mortgage to make life easier. 10-15 years later, health changes. They need assisted living or one spouse passes away. Suddenly, the loan comes due. The house gets sold. After everything is paid back, there's almost nothing left. The home that was supposed to be security becomes a transaction. And the kids, they're shocked. They thought there would be something there. Instead, the equity is gone, not because of bad luck, but because of a product designed to slowly consume it. That's not financial planning. That's liquidation disguised as comfort. Then there's cash value life insurance. Whole life, universal life. All the variations with glossy brochures and reassuring charts. This one is sold as the responsible choice for families. You're told it's protection and investing in one elegant package. Build cash value, borrow against it, tax advantages. It sounds smart, sophisticated, almost noble. In reality, it's one of the most expensive ways to do both things badly. The insurance portion costs far more than term insurance. The investment portion grows slowly, especially in the early years when most of your premiums are eaten by fees and commissions. I've seen people pay tens of thousands of dollars over years and look at their statement wondering why the cash value barely moved, and when they finally try to access that money, they're told they have to borrow it from their own policy at interest. That's not flexibility. That's a very polite trap. What makes this product especially dangerous is how it's framed emotionally. It's sold as love, as responsibility, as taking care of your family. Nobody wants to argue against that. But when you run the numbers honestly, a simple term, policy combined with straightforward investing, often leaves families far better off. More liquidity, more control, more choices. Cash value policies aren't pushed because they're better. They're pushed because the commissions are enormous. Both of these products share the same quiet outcome. They reduce freedom over time. They lock you into decisions that are hard to undo. And they shift wealth away from families and toward institutions, one polite conversation at a time. This isn't about math anymore. It's about what kind of future you're leaving behind and whether comfort today is worth constraint tomorrow. Let me slow this down for a moment, because behind every product we just talked about, there's a person, not a spreadsheet, not a projection, a real human being who thought they were doing the right thing. A few years ago, a man came up to me after an event. He was in his early 70s, retired engineer, sharp guy, built things his whole life. He told me he had done everything by the book, saved diligently, trusted his bank, sat through the meetings, signed the papers he was told were safe. He smiled when he said that part, but his eyes didn't. He had put a large portion of his retirement into products that promised stability, guaranteed income, peace of mind. What he didn't realize, what nobody ever slowed down enough to explain, was how much growth he was quietly giving up year after year. Inflation kept moving, fees kept draining, and one day he finally did the math. Not the math they showed him, the real math. He told me, "Kevin, I didn't lose money, I lost time." That sentence stuck with me, because time is the one thing you can't earn back. When he realized what his money could have been, what it should have been, he wasn't angry at the market. He was angry at himself. That's the cruelest part of this system. It convinces people to blame themselves for outcomes that were engineered. He asked me if he should get out of the products. He knew there would be penalties. He knew it would hurt in the short term. And what he really wanted wasn't a strategy. He wanted permission. Permission to admit that something felt wrong. Permission to change course without feeling foolish. I see this over and over. People don't regret trusting too little. They regret trusting too much. They regret not asking the uncomfortable questions. They regret assuming that professionalism equals alignment. And they regret it quietly, because nobody likes admitting they were misled, especially later in life. If you're watching this and something feels uncomfortably familiar, that's not an accident. That's your instincts catching up. This isn't about shame. It's about awareness. You're not late, you're not broken, and you're not alone. The moment you recognize the cost of blind trust is the moment you start taking control back. And that moment right there is where real change begins. Now let me give you something far more valuable than fear. Let me give you leverage. Because once you understand how this game works, you don't need to be angry. You need to be prepared. Control doesn't come from knowing every product on the planet. It comes from asking the right questions and refusing to be rushed. Before you sign anything, you should be able to get clear answers to 5 simple questions. Not complicated questions, not academic questions, simple ones. What are the total fees I'm paying every single year all in? Not just the obvious ones, all of them. If the answer sounds vague or requires a chart to explain, that's your first red flag. Second, what happens if I need my money sooner than expected? Life happens. Health changes. Plans change. If your money is trapped, you're not investing, you're surrendering control. Third, how does the person selling this get paid? If the answer makes them uncomfortable, congratulations, you just learned something important. Fourth, what happens in a worst-case scenario? Not the brochure version, the real version. And finally, what would this money look like if I did absolutely nothing fancy and just kept it simple? Those questions alone will eliminate most bad decisions, not because the products disappear, but because the sales pitch falls apart under sunlight. Complexity hates transparency, always has. Here's the principle I live by, and it's served me very well. If I don't understand it, I don't buy it. If I can't explain it in plain English to someone else, I don't own it. And if it requires a 30-page document to justify why it's actually good, it probably isn't. Wealth is not built through cleverness. It's built through discipline, patience, and avoiding unnecessary mistakes. Simple doesn't mean unsophisticated. Simple means flexible. It means liquidity. It means low fees quietly working in your favor instead of against you. Over decades, that difference compounds in ways most people never fully appreciate until it's too late. The irony is that the most powerful strategies often feel boring. No drama, no exclusivity, no velvet ropes, just results. Now let me say this clearly. This isn't a call to hate banks. Banks are very good at what they do. This is a call to stop outsourcing responsibility for your future. Nobody will ever care about your money more than you do. Not your banker, not your advisor, not the institution with the marble lobby and the free coffee. You. If this conversation made you uncomfortable, that's a good sign. Discomfort is where growth starts. If it made you rethink a product you own, even better. And if it helped you avoid one bad decision, it may have saved you years of regret. So take this information and use it. Share it with someone you care about. Ask harder questions. Demand clearer answers. And walk away the moment something doesn't make sense. That's not being difficult. That's being in control. At the end of the day, wealth isn't about beating the system. It's about not being quietly drained by it. You now know how the game is played. The next move is yours.